Hey everyone, it's Daniel here from etfs. Hope you're all doing well. So rate hikes for tomorrow is off the table. So the US Central Bank comes out tomorrow. They're planning or they're deciding, they're going to decide tomorrow at 2 p.m. whether to hike rates or not. And the probabilities in the market suggest that there is a very low chance, a 2% chance that they will hike tomorrow, which is super low, which would mean that after such a long rate hike cycle, they're finally going to pause in tomorrow's meeting. Now, why is that? What happened? What caused that change? Why was the market previously, if you look at the previous months, pricing in that they were going to hike tomorrow, and that completely changed now to a 2% chance and basically a 98% probability that they're going to pause? What happened? What changed here? Well, what changed here was because of the US inflation report that came out today. The US inflation report came in lower than expected. The headline number came in at 4%. You're going to hear it in the news. You're going to hear it in the media. Inflation's down. We won. Inflation's down. 4%. Woohoo! Right? So that's going to give the euphoria in the markets, and that's why you saw the equity markets rally on that report and also bonds as well. But when you go to the grocery stores, when you look at rent and you look at other areas, you don't feel like prices have coming down. Why is that? Well, take a look at the core number. The core number year over year came in at 5.3%, which is in line, which is no change. No change. Well, when you look at the month over month number coming at 0.4%, and especially the unrounded number, it is slightly higher than the 0.4%, suggesting a little bit of hawkishness, a little bit of a hotter number, but still, again, relatively in line, which is what caused bond yields to shoot back up again and bond prices to come down. So on the initial number, yes, we had the euphoria and the optimism, but then the bond market was like, hey, this is not a done deal. Although we may get a pause tomorrow, but it does not stop the US Central Bank from hiking rates down the road, right? July, in the next meeting, there is basically a 65% chance that you're going to see a rate hike. And that's a high probability. Right? And this number can definitely change. We still have more data points to come out. We've got the next inflation report, the jobs data, etc., etc. If that comes out hotter than expected, then sure, you can see the Fed go back and hike again. So rate hikes are not off the table, but in terms of tomorrow's meeting, we could see a pause. And we'll have to continue to see and analyze how the data comes out. And the Fed's also going to most likely say tomorrow that, hey, we're going to continue to be data dependent and we're still leaving the door open for rate hikes. And if it's needed, we're going to hike rates. We're going to continue to hike rates to bring inflation to our 2% target. They're going to reiterate this. 2% is where you want to hit and where you want to strive. Now, if you look at the equity markets, they're in full-on euphoria. You're seeing, the bullishness coming back in. We're back in a bull trend, right? Because how the equity markets are feeling is that, hey, with all these rate hikes that are happening, inflation's coming down, well, at least on the headline component, and we know that because energy prices are down and down quite substantially, right? But the core number is still in line. So it basically tells you that, yes, we have come off from the peak, but the economy is still doing fine. The jobs are doing fine, ignoring, yes, the ISM and other growth numbers. But look at the job report, it's doing fine. Inflation is somewhat coming down. That means rate hikes are going to slow down, which means Yahoo in the stock market. And that's where you're seeing this move up higher in the equity markets. Now, going into the core number, the core CPI number, there were certain reasons why that number was in line, and you're still seeing the stickiness in the inflation report in certain sections. And what that section is, what are those sections? Well, there's 3 sections of the core number that is causing inflation to be sticky. That is number 1, shelter. Shelter continues to be elevated and was a major contributor to the core number, which is why you're seeing that inline core number there. Second one are the used cars and trucks. moving up higher as well, contributing to the stickiness and the highness in the inflation report. And third one, which is most important for all of us, is food. Food at home and food away from home continues to be at elevated levels, which is creating that stickiness in the inflation metric, especially the core component. So yes, headline is something that maybe the consumers look at, that the markets look at, that the media is going to pump in, but the central bank, the US central bank, doesn't only want the headline number to come down, and the reason why the headline number is down is because of the energy prices, but they want to see the core number come down as well. The shelter component, the rent, the housing prices, they're not going to say it explicitly, but they are watching that, they are looking at that, and they want to bring that number down, which is why you saw bonds sell off, the yields go back up, and pricing in that, hey, we can still see further rates this year. So it's not over, it's not done with, right? But it doesn't mean that you can't still get the euphoria in the markets. It's just a very different sentiment between the stock market versus the bond market. But the bond market is telling you that, hey, this is not over. Stock market's in a different completely world. And we're going to have to just continue to be data dependent, watch next report of inflation, watch other data points as well, Chinese numbers as well, where we've heard and are starting to see that Chinese are experiencing lower prices, they're starting to ease now, etc., etc. Start to view the other CPI reports around the world and continue to watch the data and the labor market in this slowdown, and it'll be interesting to see how the Fed and the US Central Bank reacts. So let me know what you guys think. Leave a comment below, subscribe, hit the like button and bell icon to be notified on the next video, and I'll see you guys around. Cheers, bye.